Hello, my name's Peter Mauthe, and I'll be presenting Trademark Capital's discussion on Trump 2, what to expect during his second presidency. You know, we've just come through this election, and it appears from conversations with advisors as well as investors that there are two very extreme views with very little in the middle. And so today we want to discuss what to expect without regard to whether you are happy with or unhappy with the results of the election. Since I've got a number of slides here and only a few minutes, let's get started. The U.S. government today is large and growing. I can attest to this since I live right outside of Washington, D.C., and there are many, many buildings under construction today, even though each presidency in recent memory has talked about controlling the growth of the government. The government is also inefficient in many ways. Costs often outweigh benefits to society in government programs. The government is also ineffective in many ways. Take, for example, Social Security, the national deficit of nearly $2 trillion a year in recent years, and the national debt of approaching $37 trillion. Complex government rules and regulations that are often more costly than effective, seldom coordinated, and not uniformly applied. Let's take a couple examples. The solution to Social Security running out of money in 2034 and the ballooning national debt exceeding $50 trillion by 2034 has had known solutions for over 45 years, but no meaningful corrective action has been taken by any Congress or any president. Now, let's talk about the fears and hopes for the future of the United States, given the polarization of investors and investment managers today. The fear tends to be the Trump machine will bring radical and harmful change. But worth noting is the fact that the U.S. economy and its markets have survived the Civil War, the Great Depression, World War II, the Nixon and Vietnam era, the inflation of late 1970s, and the financial crisis. And here we are today. The hope is that meaningful change will happen to solve many of the major problems we face, but have been unwilling to deal with the consequences of the needed solutions. Worth noting here is major changes seldom happen passively or comfortably, and great expectations are seldom fully achieved when manipulated or implemented by the government. What does this mean for market expectations? Well, let's take a look at the stock market. But for the next 10 years, the stock market has a great probability of returning very little on a buy and hold basis. The reason for this is historical in basis. Today, we are starting the 4 years of the second Trump presidency with a PE level of the popular S&P 500 index at around 23. Historically, PEs of around 23 have led to future 10-year returns near zero. So even if the returns of the stock market going forward are near zero, that can't be blamed solely on a Trump presidency or the Congress that we have today, because it's already been built into the expectations of where the stock market is today. Now, take a look at the bond market. The bond market today has seen a 100 basis point increase. Oh, by the way, the yield curve here shown from 1 month to 30 years. And the black curve is the year ago yield curve. You can see how inverted it was. And the blue line is the yield curve today. The yellow line shows the usual trajectory or the usual slope of the yield curve under normal economic circumstances. After the Fed lowered interest rates by 100 basis points, you can see that to the left. You can see that interest rates have come down on the short end of the yield curve, which the Fed controls, but the yield at the long end of the yield curve actually has gone up over that period of time. Now look at where the yield curve is today, the blue, according to what the normal slope of the yield curve is. And even if the Fed continues to lower interest rates over on the left-hand side of the screen, down towards 3.5% from its current 4.25 to 4.5, you can see that yields on the curve, the Treasury yield curve, from 2 years to 30 years are already reflecting a lower yield curve at the left-hand side of the short-term end of the yield curve. This simply means that the bond market has already anticipated greatly the expected decrease in interest rates over the next 2 years. Now, you can follow Trademark Capital on our website at trademarkcapital.com. You can email us at info@trademarkcapital.com. You can follow us on X, YouTube, and LinkedIn. If you have suggestions for any future videos, please don't hesitate to contact us. Thanks for joining.